All of you have an option to start your video. If you are comfortable, you can put on your video. We will, there are more than 50 odd people in lobby. They will join. We'll start the session within 1 minute. So first of all, welcome and thanks to everyone for joining this webinar, which is planned by AVA Network. This is a topic which all of us are aware. This will impact individually all of you and as an employee, as an organization, as an HR head, as a CFO. It will impact everyone starting from the CXOs to each individual employee. So we thought of for all our clients, let's do a webinar where we'll try to decode this wage code. As of now, the various wage code has been pronounced. Rules are yet to come, but whatever basis best knowledge, we will go ahead and discuss on the practical aspects from an implementation perspective. Very briefly about AVA. So as you see, we are a 360-degree stack firm wherein not limited to just assurance or direct tax. We are into one-stop solution for our clients, be it assurance, be it internal audit, risk advisory, transfer pricing, be it internal audit, etc. Wherein we try to ensure that we provide end-to-end solution for our client, be it in India, outside India. So directly, I will introduce today's speaker. We have three renowned speaker for today's session, starting with Girija. Girija is a principal legal advisor at Legalogic, have an experience of 9+ years. She has worked on various negotiating general commercial contracts. She's advising structured deals for real estate, succession planning, employment law in India. She has a vast, rich experience in employment law and advised on various matters such as POSH, employment documentation, policies, etc. She is an external member of IC committee by POSH Act and independently conducted trainings and awareness program for employees. Join me to welcome Girija as our esteemed speaker for today. Along with Girija, we have Kritika. She's a legal advisor at Legalogic, have 7 years plus experience in industry and has specialized in labor, employment and corporate laws. Currently, she is pursuing PhD in law. Further, her experience spans from labor compliance, industrial relationship, policy development, and has a practical implementation on labor and employment regulation and assisted HR in a lot of practical and legal requirements. She's a POSH certified investigator and helped a lot of companies take it forward. Welcome, Kritika. Last but not least, our own partner, Mayur Zala, who is a professional having 13+ years experience working in direct tax, personal taxation, and transfer pricing international taxation. He's already advising large corporate clients on a lot of structuring, corporate taxation, and various other things. He has an experience of 10+ year in big six firms before joining ABA, and a combination of legal on a panel and a personal taxation, combination of both between Mayur, Girija and Kritika. They will cover every aspects of this laws which has come up. Without wasting any time, I will hand over to Girija. Girija, you can take it up from here.
Thank you for the introduction. Kritika, if I may request you to share the screen.
Yes.
Yeah.
Yes. Is this visible?
Yes.
Okay. So good afternoon, everyone. We are here from Legal Logic, and I'll just take a moment to just introduce our firm and our practice area. And the fact that we are a full service law firm and we have expertise in labor and employment laws. We practice from commercial contracts to M&A to litigation, IP. However, amidst the changing laws, data privacy, labor laws, we have been spending some considerable time in understanding and studying this. And hence we have taken this opportunity to, cut through the buzz, cut through the noise that has been existing around social media, on the internet, about everything, every possible interpretation that the labor codes has brought with it. And we take this opportunity to understand that more than the chaos, this entire shift is more like a launchpad for innovation and adopting simpler approaches towards employment, uh, and also overall bringing operational flexibility and ease of doing businesses. So this entire shift we see as more like a balancing scenario rather than centric to employees or centric to employers. It brings a good balance, and with that, we will start the session. Girija, do you have any introductory inputs?
Sure. So thanks,
I think
Kritika, for
so.
introducing this.
Girija just told, I think so. We see some messages that few of the audience are not able to hear. Let me just
Yeah.
reconfirm with them. If as of now the voice is clear, please put on the chat box. It's clear. If not, you can put again request you to check the network or please leave. No, I think so. Others, if anyone, okay. Well, Venkata has confirmed it's clear. Okay, nice. I could see from most of the participants it's clear. Over to you, Girija and Kritika.
Thanks. Uh, Now that everybody's, on. Hello. Yeah.
Yeah,
So
you're
now that
audible,
everyone
Girija.
has joined the session, just wanted to make a a brief introduction. So what are we going to discuss today? So we are going to discuss today all the four codes. We are not just going to discuss the legal, changes that it is going to bring in, but also the paradigm shift that is being to redefine ease of doing business in India. So how the CTCs are to be structured, when we make changes in the CTC, how our policies get impacted, what more we need to do from a policy point of view, how it is now from doing a if you have multiple locations in India, how your policies are going to be reviewed, how your compliances are going to be reviewed. So all of those points are something that we are going to capture one by one today during the discussion. To start with, we'll give you a roadmap as to the initial preliminary insights about the four codes. So over to you, Kritika. You can start with the next slide.
Thanks, Girija, for setting the context. So basically, before going on to any discussion on the subject matter, let us look at the intent of the law of why these changes have come into place. For a long time, we have been struggling with, complex and voluminous laws in the labor and employment sector, wherein there were a lot of inconsistent concepts, lack of uniformity of definitions, extremely compliance heavy procedures, manual efforts required for all of these bookkeeping, etc. So India, I think, is on the move for consolidating a lot of complex laws, bring in uniformity of complex definitions, simplify compliances through digitalization, and all of this together sets base for why the labor codes have been enacted. Substantively, they subsume the same laws as they were by repealing and by subsuming the already existing multiple legislations. There are some new additions that are going to bring some significant approaches, changed approaches of functioning, but a lot of things remain the same as well. A lot of provisions that have been highlighted or probably, called out in bold letters, but they are not necessarily new. They are already existing norms. It's unfortunate enough that it has, to be removed. For example, the mandation on issuing an appointment letter. Imagine, the plight of our employment regulation, that this is something where the law needs to remind organizations to do so. So that is what has happened. It has been recodified. It has come with four strong brand messages. One, uh, you know, uh, the four blocks that you can see on your screen: consolidation of complex laws, uniformity of definition, digitalization, simplified compliances, gender parity in pay practices, also ease of doing business and operational flexibility for employers. So this is the agenda of why the codes have been brought into the picture. So just a quick snapshot of what the four codes are. We have the code on wages that subsumes all the laws related to the payment of wages, minimum wages, etc. We have the code on social security, which subsumes everything related to social security benefits, your PF, ESI, gratuity, maternity benefit, all of these come clumped under the social security code. Then we have the industrial relations code, which brings together the laws related to industrial disputes, industrial standing orders, unions, couple of, new provisions under this code as well. And then finally, we have the occupational safety, health, and at workplace, code, which the common notion is that this one is not applicable to IT, ITS companies, but we come with a different understanding. The way establishment is defined under this code certainly brings about its application on IT, ITS companies and commercial establishments as well. How will be the standing of this law? What will be the cross play between the OSH code and the Shop and Establishments Act? All that we will understand. So currently we don't have a language that repeals or, brings a parallel nexus of Shop Act with the OSH code. So probably we have a situation where both things have to be interpreted together with a more beneficial construction. So what is going to be the interpretation strategy is what we'll understand. But if we look at it at one glance, we see these four key business impact areas that the labor codes bring with them. We have the financial implications. How will pay structures get impacted? What would be the budgetary impact of all of this? The employer-employee relationship, there is definitely a lookout on retention, attrition, your entire workplace dynamics that revolves around the relationship the employer and employee has. Of course, with respect to HR functions, there could be some new challenges that await the HR teams. And finally, we're going to look at the employer-regulator relationship as well. What do companies need to, what steps do they need to take to ensure an ironclad adherence to compliance norms? The shift of the inspector to the facilitator, the mediator role, is that really going to bring some help and ease, or is it just the sake of nomenclature? We will look into these aspects. With that, let us look at the key highlights of the main changes that come. But before that, I want to address something very important, which is implementation. Now, there has been a lot of buzz regarding the fact that if the labor codes were already enacted in 2019 and 2020, what was the 21st November notification all about? So I'll just give you a little bit of a political context. Since labor and employment is a concurrent issue, obviously, once the center had enacted the codes, it was also the state's responsibility to enact the rules. And in that process, there was some back and forth and resistance. Not all states were up to speed with the required deadlines. We have had states like Maharashtra where all the rules for all four codes were out, but there were many states like West Bengal that had not acted on even one code. This was bringing in speculations that the fate of labor code could fall the same same as that of the farm laws, and there were questions in the parliament that would the labor code be even implemented. And as a strong answer to these speculations, the 21st November notification came in saying that the codes are implemented, are due for implementation with effect from the very same day. And of course, in this process, they understand the need of organic transition. This is not something that can happen overnight, especially given that all states have not taken out their final rules currently. The complete legislative process is remaining. Even for states like Maharashtra, where all four rules are out in the draft stage, the public feedback and all of that is still remaining. So they foresee a period till April 2026 to for all this clarity to roll out on table, and hence we can deem or understand this period as a transition phase. However, I would like to highlight that there is no documentation where they have recognized on paper that you can wait up till April 2026 to bring about the changes. So our understanding is start acting now, understand the material effects, and wherever there is clarity, start enrolling those changes, now itself, so that everyone is saved from last moment panic. And of course, if there are things to be clarified, they will happen, like the center has promised an FAQ based on industry feedback, etc. So all of that, once as they come, they will definitely smoothen out the path for us. But despite the rocky road, I think the action can start now, especially when it comes to these changes that we are going to discuss: the impact on salary structure because of the definition of wage, the impact on social security components, the changes that come with the onboarding and exit procedures of employment, of course the change in leave, working hours, and overtime aspects, the inclusion of gig workers. This is also a big recognition of new category of workforce to bring in more security for them. And of course, finally, the changed approaches to compliances and disputes. So this is where this is all what we will be covering. We intend to help you understand that one of the biggest gaps that existed with the previous laws, which was the lack of parallel integration of the legislations, that is what is eased out. If you see, even the present labor codes, this has come into implement. It has been a work of several years. So for everything in the book as the black and white letter of law to actually roll out on ground and bring out the color of law, it needs an intense adaptability on part of course, all the practitioners that will help you transition, be it legal, financial, tax, HR, etc. But also adaptability on the organization's front to receive the changes in good light, adopt the changes, be compliant, and make sure that the employment ecosystem is changing for the good. So with this, I will, hand over the dais to Girija, who will take you through the first and the most dynamic change that the labor code brings, which is what happens to the change in definition of wages. Because now, unlike earlier laws where we had different definitions for wages, we have one single universal definition. So over to you, Girija, to help them explain the concept of wages and impact on salary structure.
Thanks, Kritika. Like Kritika mentioned, there is a uniform definition of wage under the labor codes. So if you look at all the codes, the definition is the same. It talks about what is included and what is excluded. So by consolidating by consolidating 29 central labor laws, now the labor codes talks about only a single interpretation to avoid multiple interpretation as to what should be the purpose of calculating social securities towards each resource that you engage in an organization. So if it may it be gratuity, may it be PF, may it be ESI or statutory bonus, now you have to rely on only the components that are identified under the definition of wage under the labor codes. Now, if I have to give you a couple of examples, under the minimum wages, the definition of wage was basic plus dearness allowance plus retaining allowance. And if we look at the Gratuity Act 1972, the wages were defined. It said to have the basic wage plus dearness allowance, and all other allowances were completely excluded. So the purpose of calculating all the social securities were different, and it added to a lot of administrative cost. Not just that, there were so many employees who had filed suits, and those were there. Some of them are still pending to understand whether his or her specific salary structure includes or has a specific component should be considered as part of social securities or not. So we have heard about a lot of cases on PF, to be very specific. And then there was one specific judgment which identified that whatever you pay to an employee, which becomes an universal component, will amount to basic. So that was the base for which the uniform definition was brought in picture. Now, if we look at the definition of wage, as you can see on the screen, it talks about what is included component and what is excluded component. So everything, to put it in very simple words, everything which is not excluded will amount to the included components. If you have a special allowance bonus, special allowance or upkeep or whatever you call name it as a balancing component, if you are paying that through an resource on a fixed term tenure basis, on month basis, and it is fixed, it has no deviation, it is not for a specific cause, etc., it will be considered as part of your included components. So whenever you make change in your CTC for employees considering the labor codes, we have to be mindful that we do not inadvertently put the liability of the employer on a higher side, which is beyond the 50%. So let us understand what all components could be as part of excluded uh, components under the definition of wage. Initially, if you look at for the purpose of calculation of PF, there was an understanding to also include HRA. In some instances, like payment of a maternity benefit, HRA was also included, and some cash components. Now it is very straightforward. You should not consider statutory bonus, value of house accommodation, or any other amenity that is been provided by an order of a government. Then employer's PF will be carved out entirely from the remuneration. Conveyance allowance, if you are giving two separate components, so some of the companies do have conveyance allowance plus LTA separately. So we have to retain at least one component so that another does not amount to, the included component from the CTC. So that has to be taken care of. Then some to defray special expenses. So some companies, provide holidays to employees or one-time travel offer to employees. Some have uniform allowances. So these are all categories of, or a Wi-Fi reimbursement. These can be categorized as defrayed special expenses. HRA, we all know it is house rent allowance. Remuneration, any under provided under any award or settlement, is an excluded component. Overtime that you pay to employees is also an excluded component. uh, the gratuity and commission is also excluded. To address the question that we recently got on the chat, it says, what is the retaining allowance? The retaining allowance is nothing but something that usually the seasonal employees used to get for, because they were engaged for a very specific short duration. There is an additional allowance usually is given to these set of employees, but by and large this component may not have any impact on ITITS or manufacturing units unless you are engaging somebody who is on a seasonal basis. To give another example for retaining allowances, armed forces. Armed forces employees do get a retaining allowance to ensure that if they are placed on a specific activity away from their existing location, the retaining allowance is provided to them. Now, what we have to, whenever we make any change in the CTC, what we have to ensure is your liability of all fixed components plus basic that you identify is not over and beyond 50%. Plus, on top of it, it also does not, for any reason, the excluded components are not over and beyond 50%. So the structure has to be made in such a specific fashion. If I if I may request Kritika to let me talk about the example of the definition of wage of 50%. If as you can see on the screen, now I have identified the calculation of basic HRA conveyance allowance, and special allowance. Now I have kept my basic at 10,000 and the special allowance is at 1,000. In HRA and conveyance allowance is sitting together at 9,000 rupees. So this way, what I am saying is the included portion is only of 10,000, which is basic, and excluded portion is about 10,000 specifically, sorry, 9,000 specifically. And this is how we are saying that the total remuneration that we are paying to an employee, which is of 20,000, out of it, I am straight away taking 50% as from the CTC to identify it as deemed wages. Uh, in this another example, what the law has mentioned here is there are a basic HRA, conveyance allowance, and statutory bonus. Now we are adjusting. Now the law very clearly says that if the 50% uh, of the excluded component, if the excluded component is higher than 50%, then you have to borrow that additional component and add it to the included component. In the current case, there is no specific category as to which component has to be borrowed exactly. So we have put it as a whole, and we are in from HRA, conveyance, and statutory. We have borrowed 1,500 and added it to the basic. So in any case, the bare minimum that you have to keep is 50% on the basic. I will also address all the questions that I am seeing on this specific topic. So the first question I could see is, are excluded components within CTC or not? Yes. So, CTC is nothing but the cost to the company. When you identify HRA, it has to be as part of the cost to the company. So there is no point in keeping, HRA out of the CTC entirely. So you have to build your salary structure in specific manner that you identify the cost of the company entirely, and where you keep your liability to 50% of the included component for the purpose of gratuity and PF. Now, next question that I am going to address is, how do I calculate PF? PF will be, the scheme is not yet launched. So you have to continue under the social security codes. There is a specific language which says that the PF will continue under the existing scheme itself. So for another year, until they bring up with any change and or notification that is provided, will continue under the same scheme and will contribute at 12% of the basic, which is the included component. The books and periodic allowance, food allowance, miscellaneous allowance, vehicle maintenance, fuel allowance, whether should be covered or included in CTC or not. Yes, but these categories, until and unless you identify it as defrayed special expenses, whether they are like how I have informed you about the uniform expense, unless and until they are not identified, there is a likelihood that they would be falling under the category of included components. So we have to ensure that we identify the components in a manner that we keep our liability to the lowest low. On gross, basic should be 50, not CTC. Yes, I mean that's a calculation gimmick that you have to apply basis on how you look at your entire cost to the company, your number of resources, the kind of salaries that you're offering, the components, and the regime that the employees have opted. So that can very well be taken into consideration for this. Kritika, if I may ask you to please share the screen.
Yeah, just a second. There is something that has happened to the.
Girija, there are more questions.
I
Should I
will
just?
address.
Yes,
So you
I think the
will,
screen should be visible now. Yeah, there is one question that I would like to take up over here is regarding what is the understanding of total, whether it is gross or whether it is CTC. Girija, you can add in your inputs also wherever you want to, extend to whatever I'm saying. So the understanding of total right now is more favorable when we take it as CTC, because that ways we ensure that the CTC remains the same to the company while we are making internal readjustments to the salary structure to make it more compliant. when we take it on gross, what happens is the understanding of gross differs from company to company. Also, I would like to give another disclaimer that whatever we are explaining right now is a very macro approach, because that is how it could be in these kinds of sessions. The understanding of each CTC structure is unique to that organization, and it requires an individual and micro analysis to help you understand the treatment of each component. Yeah, Greja, please continue. I'll go on to the next slide.
Yeah. So we are also looking at equal wages for all genders. This has been, the same way, but for the purpose of paying equal wages to all genders, there are certain conditional inclusions that are allowed. So if you were to calculate equal wages for having that gender neutral approach, in such scenarios, any conveyance allowance or HRA remuneration or any overtime has to be taken into consideration as part of uh, the wage, just to have understanding as to whether uh, the salary that is being provided to a male employee or a female employee or a third gender is at par or not. Now let's talk about variable pay and performance bonuses. Traditionally, wages were seen as just as the fixed salary, while bonuses or performance incentives were variable, meaning they were always kept either out of the CTC or were included as part of CTC and were paid only on the performance basis. Now, under the new labor codes, there is a gray area. There is no language around what could be the treatment provided for the variable component under a salary. So that's how we are qualifying it as gray area. But that also means there is a likelihood that it can form a part of included components, because there is no specific exclusion under the current definition of wage. So whenever we make that study for an organization, we have to give that treatment that as if the variable pay is a part of the entire CTC and how the figures would look like from a salary point of view. So that calculation and assessment has to be done. So for example, if a rule states that variable pay should not be more than 50% of total wages, any amount above that threshold would become part of the basic pay. So this is what uh, the challenge currently that we are also facing to identify what status we should be providing to variable pay. But that said, given the role of the officers under the new wage code that are appointed are not just about from an investigating officers, but they are also the facilitators. So we are also in talks with them to understand how they are looking at the specific component of variable pay. Once we have more visibility on it, we will revert on that.
Okay. Thank you, Girija, for explaining that entire understanding of wages. As I mentioned, we will have to look at each CTC structure to help with the understanding of each component. At a macro level, the understanding is that if now wages is one uniform definition, and that is the singular understanding of wages for all computation of social security components. The rule says that out of the CTC, if the excluded portion exceeds 50%, then the excess needs to be deemed as a part of wages and make that as base for the calculation of all your social security benefits. Now we move ahead with the ahead from the concept of wages, and let's start discussing some other new terms that have been recognized under the codes. Now, earlier, if you see, there was just one singular understanding, which was workman under the Industrial Disputes Act with respect to certain benefits around retrenchment, etc. Then, apart from that, there was the definition of employee, which covered everyone. However, now we have new terminologies. The concept of workman no longer exists. Now, in place of that, we have worker, employee, and fixed term employees. So if you see, employee is defined in all codes. Worker is defined in Social Security Code, Industrial Relations Code, and Code of Wages. Fixed term employee is defined in Industrial Relations Code, but has context and reference under Social Security Code as well. Now, I will give you the context of reference for each category in each code. Now, if you see worker, unlike workman, which existed earlier, now includes supervisory category also. So with the existing understanding of whoever constituted workmen, we now have an added inclusion in the concept of worker, which is supervisory category. However, it excludes supervisory category earning above 15,000 under the wage code connotation, and supervisory category earning above 18,000 under the industrial relations connotation. So which means if we take a bracket of 15 to 18,000, supervisory roles earning below these will now be considered as worker. And supervisory categories earning above these will not be included in the concept of worker. The understanding, I would just give you an example. For example, team lead. So team leads that are earning below the bracket of 15 to 18,000 would now come under worker, in contrast to the earlier understanding where workman did not include even a single supervisory category. So with this addition, what happens is all the liabilities or responsibilities that existed for workman will now extend to the newer inclusion under worker. Now, employee is an umbrella term. It is worker is a carve out. Employee includes everybody. It's a broader classification. It includes managers, skilled, unskilled, people in technical roles. Everybody on the roll of the company would be an employee. And if you see any language in the present labor code that wants to extend benefits of employment, at a broader level, have used the term employee rather than worker. If you compare this to the earlier approach, many provisions such as Payment of Wages Act and, various other provisions of, Social Security and even, occupational health and safety, the term workman or worker was used to imply that only the lower salary brackets or probably the labor people contracted by labor, etc., were more prioritized in these inclusions. But now the more universal term of employee has been brought in to imply that the codes are applicable. Many provisions of the codes are now applicable to all employees of all establishment. This is more with respect to social security components, etc. And then we have the understanding of fixed term employment. Now, this term is quite a bit of a pain point because it's creating clear confusion out in the industry. People are probably interpreting consultants and contractors to be fixed term employees. So let us just clarify that it is not so. Fixed term employees are I will just tell you the traditional definition of fixed term employees. These are people who are hired on your roll. The only difference between fixed term employees and your regular permanent employees is the duration that they have been hired. With respect to entitlement, with respect to the role that they are playing for the organization, the benefits that they are entitled to, everything remains the same. So this cannot be the same as that of a consultant or a contractor, because those roles are not on the company's roles. They are not hired by you. They are governed under their individual service contracts that you have executed with them. So they are not employees. On the other hand, fixed term employees is an employment concept. So the carve out is such that this has been done mainly because many organizations used to, on purpose categorize certain roles as consultants just so that they could avoid paying the social security benefits. And this also exposed industries to the risk of misclassification and deemed employment. These consultants could later come and claim saying that I have been doing the same nature of work as their regular employees. However, I am still I'm not entitled to any social security benefit, and hence I claim deemed employment. So to save both employers and employees from these kinds of confusions, the term fixed term employment has been brought about, which ensures that the organization also has flexibility of duration, where if they feel that a role is, they don't want to keep that role for a long permanent time, they can keep it for, let's say, 11 months, 12 months, more than a year, etc. But they also recognize their employment rights. The only addition to this understanding is the fact that now fixed term employees are entitled to gratuity after completing 1 year. But this 1 year gratuity rule is only centric to fixed term employees, and it is not for contractors and consultants. There is so much buzz in the market that, the contractors and consultants are, just a second, I think I've lost the PPT again. Yeah, so I'll just continue. What I mean to say is, there has been a lot of buzz that now consultants and contractors are also entitled to social security benefits, and this has created an unnecessary confusion. This is not the truth. Now, moving on to the next aspect of employment, and linking it back to the social security benefits. Because if we look at how the concept of wages have changed, gratuity is something that is definitely going to take the hit. PF not so much. If you already have your PF capped at 1800, it is not going to undergo change. But yes, if you calculate your PF at 12% of wages, then since if your wage is disproportionate and it's going to inflate, your PF might also inflate. However, now the law has also called out the voluntary PF option, which was also already there, but it has been re-recognized or reiterated in the law to make sure that employees can suit the convenience of the employers can suit the convenience of the employees and make them choose between the 12% calculation and the 1800 cap. Now, all of these would require some vigilance on the net pay of the employee and overall CTC, but of course, there could be a balanced approach. Now, coming to the onboarding aspects. So the only change under onboarding is that organizations are now to issue mandatory appointment letters. Of course, as I mentioned in the very beginning, this is not something that needed a reminder, but it does, because we were flouting these responsibilities somewhere. What happens with just the offer letter is that it is not a complete employment contract. Appointment letter rather confirms the appointment of the employee, and this is the document that should have all the clear terms and conditions, all the salary clarifications, all the benefits, what type of employment, and all of this. And hence the issuance of this document is mandatory. I would now, hand the dice back to Girija to help you understand some retrenchment aspects, what has changed under retrenchment and exit. Over to you, Girija.
Yes. So if we look at the retrenchment, more or less the provisions have been the same, except for the clarification that they have brought in under the definition of retrenchment now. So when I say the definition of retrenchment, the retrenchment as a concept will only be applicable to the workers and not to the employee at large. So whenever we see any kind of severance pay case, or somebody asking you to pay an additional sum of money, first step that we need to identify is to assess whether that category of individual fits into the concept of worker. If the answer is yes, then certainly he would be entitled to the retrenchment amount or quantum, and not otherwise. Another kind of concept that they have introduced is by creating a reskilling fund for those workers who have been retrenched. Until today, the industrial codes or the industrial act, there was no provision as to reskilling of funds. Now organization will have to electronically transfer an amount which is somewhere equivalent to 15 days of last drawn wages for each retrenched worker to a designated account maintained by the central government. So that amount has to be deposited, say somewhere within the number of 10 days of the date of the retrenchment of that employee. Another clarification that the labor codes have brought in is that they have identified the concept of fixed term employment under the wage code would not amount to, if you keep on renewing your fixed term employment contract, or if the contract has come to an end, that would not entail to an retrenchment as a concept, because we have seen a lot of employees who used to work with companies on a project basis have claimed for the severance pay. So that clarification has also been provided under the retrenchment definition.
I will just
Another
add into one question that is relevant to what you were just speaking. Girija, you can also give your inputs, which is regard. So there is a question saying that if there is a fixed term employment for 9 months and then it is renewed to another 9 months, will the 1 year gratuity rule attract? My understanding of this question is it is not written in the law that the 1 year completion should be in one go. The understanding is that if your fixed term employment, either through a continuous contract or through renewals, has completed more than 1 year, they will be entitled to gratuity at a pro rata basis.
right.
Yeah,
Uh,
we can go ahead, I think.
yeah. So another classification that we have seen, like I could see some question around Mathadi workers. So these are all, we have to identify and make that assessment because the Mathadi law in Maharashtra is a separate statute and it has not been repealed as yet. So for them, the law will still continue as far as the state of Maharashtra is concerned. Now, looking at it and the new definition of workers that we have identified, which as you can see on the screen is unorganized sector, gig workers, platform workers. So if we have some workforce who is working with us on a part-time basis or not working with us on a full-time employment basis, we have to understand whether they form within any of the definition of gig worker or platform worker. And if the answer is yes, you would also have to, pay them some certain kind of insurances in a way. So the government is yet to come up with a scheme. If I have to give you an example of Ola or Uber, for those drivers who are working with them on a platform basis, there is a provision made under the code that certain extension of healthcare, pension and disability, or maternity or injury cover has to be provided. So we are still waiting for the schemes under these specific categories to be rolled out. Once those will become mandatory. And until that, the action on the organization at large is to understand whether our nature of business have the gig worker category working with us or not. And we have to also ensure that the legal recognition of unorganized or temporary workers lay down a better uh, groundwork for working conditions for the unorganized sector. So these are the good changes that we could see under the social securities for by providing them certain set of insurances. So we have to be mindful about what changes the codes are going to bring and how it impacts us as an organization. Next, if we talk about is the compliances that we need to make under the labor codes. As Kritika has already explained it, the understanding about the codes is to make our job very easy. So we have seen about the Shram portal. Uh, all of those have made it simpler to make one set of consolidated compliances or returns. You can ensure that you have one uniform form for all returns to be filed and uploaded on a government portal. No need to go and uh, through the physical or traditional way of filing of returns. So this way you can have unified database to simply track and ensure that all the work is done. Then aggregators, there is a specific requirement identified. Aggregators may be mandated to contribute a definite number of percentage, maybe 1 or 2 over and above their turnover towards the social security funds. So this is an additional layer or protection for the workers and employees to ensure that they are also getting benefit towards the social securities from the aggregators. Now, the cost of compliances, initially because of employers engaging heavy volume of gig or daily workers or freelancers, the need to enroll them in accident insurances, healthcare, the liability used to sit on the employer directly. Now, this liability would be mitigated by way of insurances and healthcare coverages. So that the kind of approaches that we need to do is also ensure that the policies are adjusted to make that shift of inclusion and the cost intermediaries, whether that cost has to be borne by us or the aggregator or the contractor has to be specifically called out. and identified at an organization to organization level.
One addition
Now,
that I would just want to make regarding the compliance, aspects that Girija just mentioned. Very importantly, two new things have been introduced. One is web-based inspections. So now, once those systems are ready, we will have online inspections where physical visit of the inspector and physical submission documents will no longer be required. Apart from that, now during an inspection, there has to be a cap of 5 years. They can't inspect documents and evidences from beyond 5 years ago. That has been streamlined, and suo moto and arbitrary actions will now be curtailed, and also made sure that any such inquiry will have to wrap up within a given timeline of 2 years.
right.
So these are
And
some
of course,
additions that, yeah.
the approach of the inspector has also changed. They will not immediately take an action, pass an order, and ask us to pay certain a penalty. First, the approach has changed from a perspective as to they will identify whether, rather give us an opportunity to correct or make changes in our records. If that attempt does not meet ends, then there would be an action taken by the inspector. So the role of inspector has also changed to facilitator come officers to also avoid any kind of penalization or penalties to be imposed on the companies at large. Um,
Yeah.
there is
So,
again overall a reduced ambiguity and administrative overhead for the domestic and international workers as well. Uh, so that is certainly a change that we have identified. And again, the kind of environment that the new labor codes has created is more attractive towards the investment climate by ensuring that the worker welfare is uniformly protected, rather having any multiple definition and multiple chaotic situation for the company to run the business in India.
right. So with all of that, we definitely see a shift in how authorities would be looking at organizations. There is also one very interesting mandation that, no suo moto actions, as I said, can start. And if there is a default, companies are to get a mandatory, 1 month improvement period. And only if there is non-compliance in that improvement period as well, will there be any room for inspection. So with this, there is also one ease that, earlier 22 offenses or 22 defaults, accounts of defaults had criminal penalties, which has now been decreased to around 16, where only 6 are non-compoundable, meaning no improvement and direct punitive action. These mostly revolve around the social security components and contributions. Otherwise, everything else is compoundable. So there needs to be a clear intent, malicious intent of the employer that needs to be proven before going into any punitive action, in contrast to the earlier approach where the employer was always assumed to be, out of having malicious intent and exploitative towards the employee. So this is definitely going to be a big relief. So before, continuing, I would just wrap up to help organizations understand what should be your way ahead. You should definitely think of the ongoing period and month as your diagnostic phase, where you seek help of experts to review your existing practices, get a look at your CTC structure that exists, the policies, employment documents. All of these should be rechecked, reviewed, reglanced with the lens of the new labor code. You could probably see, rolling out some pilot changes in the next 60 days, and in the next 90 days, make a full throttle implementation plan and roll out everything, which includes robust training sessions internally from the leadership to HR to all cross practice teams that will be involved in the implementation of the labor codes, and even the employees who need to understand that unnecessarily there is no need to panic. And this brings the nexus of a multidisciplinary lens to this entire implementation. We strongly believe that while the legal aspect helps you with interpreting the law correctly, of course, you need to recalibrate your systems with the correct financial and taxation guideline. You need to understand that, these things are beyond changes in the rule. This needs a systemic transformation. The For example, the new definition of wages with respect to PF contributions, ESI, bonus, gratuity, all of these impact your numbers. So there definitely needs to be an understanding of how to match your policy with your numbers, with a multi-state consistency. So whether it is HR, legal and payroll, all expertise needs to come together. And with this, we would want to, hand the dais over to Mayur, who will throw some light on the expertise with, the understanding of taxation. Mayur, would you want me to continue sharing the slides? You can help me to understand when to change the slide, etc.
Sure, Ritika. I think it would be helpful if you can continue sharing
Sure.
the slide. Yeah.
Over to you, Mayur.
Sure. So yeah, first of all, thanks to Kritika and Girija for sharing such insightful details about the obviously legal aspect and also practical implication that it might have over say next few months and obviously from next financial year as well. So I think it's all the more reason for us to understand from a tax perspective also how it will unfold. I mean, what kind of implication will be there for companies, what are the steps that we need to identify basis the review, and how do we prepare for the upcoming, I would say, or rather, already implemented labor codes. Obviously, there will be a detailing in terms of rules that might come at a state level also. So that will obviously change the way the whole HR function will operate. And at the same time, it will have, I would say, consequential or cascading impact on the finance team and tax team as well. So before we go into specific implications or area on a broader level, what has happened is that while there has been new labor codes and there have been changes in the definition of wages and there are a lot of other changes, but at the same time there has not been any changes from a tax perspective. I mean, income tax law would remain same. Just to give an example, that the threshold for exemptions with respect to say gratuity, leave encashment, and all the other retirement benefits still remain same. But at the same time, since there has been change in the definition of wage, obviously there would be say increase in the quantum of all these benefits. So while there would be say corresponding reduction in the net in hand on a ongoing basis for an employee, and at the same time there would be corresponding increase in the at the time of say FNF settlement. Now, considering that there are no increase in the exemption or a deduction threshold, obviously there would be some bit of tax implication for the employees at the time of FNF. Similarly, on an ongoing basis, it might so happen that because of the increase in the basic pay, or I would say the included component categories, HRA from a tax perspective is linked to basic pay, right? So there might be a situation that there is increase in the HRA component, but your rent, your actual outflow may not immediately change proportionately. So that could also impact on an ongoing basis. So yeah, broadly what I'm trying to do here is that there is a disparity in terms of the changes which are done or implemented in the labor codes, but at the same time tax law remains same. So with that background, some of the I would not be able to cover all the points considering the time limitation, but yeah, there are some key ones or relevant which could possibly help you in terms of estimating what would be the probable tax implication and obviously consequential financial impact in your P&L. Now, to start with, we have the section 43B, right, where the statutory liabilities in the form of gratuities, leave encashment, all the other statutory liabilities are deductible on a payment basis or on a contribution basis. Now, because of the changes in the law, there we probably see an increase in on this liability, and obviously then employer will have to value it accordingly, and there would be higher debit to your P&L. But at the same time, uh, income tax law will remain same, where it will be deductible on a payment basis. So while there could be a higher debit to your P&L, which could impact your book profit, but at the same time, taxable profit will be different. So there would be element of deferred tax, and obviously, it will accordingly change your EPS as well from a, I would say, shareholder perspective. So that is one implication. how it will actually reflect in your books of account, what could be the possible impact will depend in terms of how company is aligning their existing structure and revising it to make it align with the new labor law. While it is not mandatory to align your structure with the new labor law, but yeah, your gratuity and other liabilities will definitely has to be calculated as per the revised structure. So there is also possibility of dual payroll, which you might have to parallelly run and track it. So there would be, I'll also cover that subsequently, but that is also one aspect which could obviously impact the administrative efforts, higher costs on HR functions, and obviously from a documentation perspective. Uh, Girija and Kritika, they were discussing about this contractual employees or platform or gig workers, right? So obviously on a fixed term employees, there is a bit of, I would say difference of opinion in terms of how it will be treated. But from at least from a platform or a gig workers perspective, now that they are also eligible for benefits in terms of gratuity and other retirement benefits or a PF or insurance, right? So from say an employer perspective, when we carry out withholding or when we do a monthly TDS on the payments that we release to such, I would say, resources or workers, obviously it is not being currently done under section 192, which is TDS on employees or TDS basically on the payroll payment. But now that there would be a payment of gratuity and similar other benefit to such workers or such resources, how would you treat that from say withholding tax perspective? Whether you reclassify that and apply section 192 for a TDS, or whether you will continue to apply that under section 194J or 194C, because those are the applicable provisions, TDS provisions when we carry out TDS for such payments which is not in the form of payroll. So that will depend upon, and obviously right now there is no clarity, but this is one point which one should ponder upon, and it's food for thought in terms of, how do we structure the payments and accordingly, how it will need to be characterized. At the same time, as they mentioned earlier that appointment letters is compulsory. So this point will also be relevant. So when an appointment letter is issued to such workers or resources, what you should keep in mind from a language perspective, so that while it meets the requirement of regulations and it is comprehensive, but at the same time it does not land you in any trouble from say tax perspective. Uh, while I'm talking about say direct tax and TDS, but at the same time there could be some implication from say indirect tax perspective also, GST perspective also, right? Because if that person to whom we are making payment, if that person is registered and crossing certain thresholds, so then this additional payments in the form of gratuity and other benefits, how do we factor that, like from a supply perspective, from a GST perspective, how do you interpret that and whether you include or exclude that? So these are all, I would say, open case or open scenario. And at the same time, while I'm talking about say from employer perspective, but from that recipient perspective also, so for employee, there is an exemption or deduction for gratuity and other benefits. But for recipient who is not falling in the definition of employee, there are no express deduction or exemption for such, gratuity or other payments. So whether they will be eligible to claim any deductions or exemption, once they are able to claim exemption or deduction, if any, then how should employer factor that while carrying out withholding or a TDS? So these are all, I would say, connected questions and points which we need to think about while we revise or implement a new structure, or even if we are not revising, it will still apply and impact the all the employers and at the same time the recipient or employees as well. Kritika, if you can move to the next slide. Yeah, thanks. Yeah, we were earlier discussing about this 50% threshold, right? So there are included components and then there are excluded components. Now there are specified list of excluded components. And as we all know, now most of the companies, they also provide some sort of ESOP benefit, or they might provide RSU, or there may be even situation where there could be cash settled ESOP as well. Now, what should be the treatment of this benefit? Considering that sometimes ESOPs are also based on performance. Obviously, it's a mixed of performance at a company or a group level as well as at an employee or individual level. So considering that, should it be considered as performance pay, whether it needs to be included or excluded? And what happens is that ESOP payout does not happen on an ongoing basis, right? As and when employee exercise in that particular year, either he is being allotted an unit or he might even being allotted, or rather it might be even settled in the form of cash or a payout. So if that is also considered as a part of, I would say, included components, because it might so happen that it crosses that 50% threshold in that particular year because of the heavy payout, then it will sizably increase the gratuity and other liability, right? So there could be obviously there may be a different, I would say, interpretation for normal ESOP or RSU vis-a-vis ESOP or RSU, which are settled in cash, because then there would be question of monetary or non-monetary benefit, because there are also certain threshold for non-monetary benefit in the new law. So obviously one have to reevaluate the existing ESOP scheme, and if required, there may be a need to restructure it. From a FNF settlement perspective, also there is a very limited window now, which has been prescribed in new law. And as I mentioned, there could be multiple changes in the way taxation that will happen at an FNF level, because the quantum of retirement benefits will change sizably. So to meet this timeline of limited window, there has to be like a very strong coordination between the HR function, between the finance team, and also from a tax team, because there would be too many variables at the end where you will have to work out the taxability. You might need to get certain disclosure from the employer, or certain declarations from respective employees, because some of the deductions are available once in a lifetime, and if they've already taken certain deduction earlier, they will not be able to again claim that deduction. So completing all this process within a limited time window would be obviously a I would say not an impossible but difficult task to achieve. Uh, Last point that I would like to emphasize upon would be more from a dual payroll perspective. So as I mentioned, while it is not mandatory to actually change your CTC structure and align it with the new law, but if you don't align it, then for the purpose of computing your gratuity and other liability, you will have to reclassify certain components and then compute this liability. So this will reflect in a sense that there will be dual payroll, which you have to keep, maintain records and track it properly. And that will obviously result in duplication of effort and additional cost and financial burden. So yeah, these are some of the key aspects which I thought I will share. We do not have much time because we'll also, we have scheduled some time for Q&A session. So while I will hand it over to Chandan for moderating on questions, and then, we can answer some of the question, and obviously later on we'll answer, remaining question also through email communication. So over to you, Chandan. Yeah.
Yep. Thanks, Mayur. Thanks, Girija. Thanks, Kritika. I think so. Last 70 odd minutes, all three of you have covered uh, most of the points which we have received as a query as part of the webinar. There are a few questions which I think so, Girija or Kritika, you can take up. Like, for example, the last question is, will the gratuity on FT be applicable if organizations below 10 people? Because from a gratuity perspective, if a company has a employee below 10, what would be the scenario in the current case? That's one of the question. Either of you want to take up
Yeah,
so that
I'll
the
take.
recent
I'll
ones I can.
Good.
go ahead, Kritika.
So this is a very simple understanding. The thresholds for applicability of gratuity, PF, ESI that have not changed. The number of employees threshold, it still remains the same. So the only thing that changes with perspective of any social security component is the understanding of wages. And now definitely if something was calculated on 100 rupees earlier, but now has to be calculated on 150 rupees, that would be probably the impact, but the thresholds of applicability remain the same.
Right.
Okay, great. Great. That helps. Now, from an FNF perspective, should it be done within 2 working days or 2 days of upcoming payroll cycle?
Right. So I wanted to also clarify this, forever under the payment of wages, the timeline has categorically placed. It says that once an employee leaves, even if he is terminated or voluntarily exited from the company, you have to pay him the wage within a period of 2 days, and FNF has to be done within a period of 7 days. There is no change, or the labor courts has brought him as a new concept at all. They have just subsumed what was there existent under the Payment of Wages Act 1936, and it is continued. So
Yeah,
no
just to
change as
add to
such.
yeah, just to add to that, if you even see the current language of the law, it says all unpaid due wages should be paid within 2 days. It's the same as what was there earlier. And the existing judicial precedents that gave room for a reasonable time to settle the FNF, it still exists because the law does not say settle FNF in 2 days. So the law recognizes that asset recovery, understanding leave encashment or other things that take some time within your payroll calendar are to be accommodated within this timeline. Also, the existing thresholds, the existing timelines to clear gratuity, which is 30 days, all of those still remain the same. So it just implies that under the new provisions, the time that you have taken to clear the FNF will be tested against the concept of reasonability. So the scrutiny is more on the reasonability of the duration you have taken to clear the FNF rather than, 2 days, etc. All of that.
So just practically understanding from the question. So from an FNF perspective, okay, as you mentioned, 7 days is something which was mentioned in earlier law, which is subsumed in the current law. Okay, whether 7 days would be a reasonable period, or if someone proves that 15 days is a reasonable, or the next cycle is a reasonable, is that fine from a prejudice perspective, or a lot of
From a law
case
point of
laws
view,
which has happened in past?
see, from a law point of view, the ask is to make payment as soon as possible. That is what the law is talking about. It should not be that an employee has exited and until 2 or 3 years, no payment has been done. So that is why the law is recognizing certain timelines. Now, if you let's assume a case that you have a 30 days timeline to make all the entire FNF. Okay. By the time employee reaches the suit, files a suit and goes to court and seeks remedy, the organization would make the payment, right? So if the payment is not made within a specific threshold, there would be a situation. Otherwise, there is no penalty as such if the company or organization fails to make that payment within 2 days or 7 days. So as
Okay.
long as you make
Okay.
payment, it is good to go.
So if company has a policy of 7 days, 15 days, 30 days, as the case may be, which is a policy which is consistently followed and which is reasonable, it can withstand in law, is what
Yes,
we can broadly say.
yes,
The duration will just be examined from the point of view of reasonability. If you are taking 30 days, if the company is able to justify that, yeah, the company needs those 30 days to settle the accounts, there would be no scrutiny on that existing practice. And with this same language, the earlier cases, the judicial position has given accommodation to the 30-day practice as long as it's reasonable and not withheld with a malicious intent or a careless intent.
Okay, okay, okay. So what we'll do, as already we have it's 4:15, and the time which we had shared with our participants to close as 4:15, but we can continue with 2, 3 questions. okay, which we will take from you, Girija. And if any other questions which are unanswered, you can drop an email to Aditya. Aditya, you have Aditya's mail ID, and also he will share in the chat box. So every and any unanswered question, if any, after 2 3 questions, would be separately emailed to you by Aditya post discussion with our experts. So 2 3 questions I will just take interest of time in next 2 3 minutes. Sales
Right.
profession earns significant incentives.
Right.
Incentives were not calculated as wages and calculation as a percent of basic. How you will consider this as a part of wages for various calculation purpose?
This will fall in the category of commission when you call about sales professional getting some incentives. And if you look at the definition of wage, commission is excluded component given. So while calculating, you have to give a treatment that excluded component is, the incentive that the sales professionals are earning. Now that said, even if that commission is a XYZ amount, it should not be, if your basic is 50%, then the excluded component has to be 50%. It should not be above 50%. Is something that we have to be mindful of. This is the current definition of wage.
Okay. Considering basic is coming at 50% of CTC, okay. If a
Hmm.
company is planning to give an ESOP,
Hmm.
will it be they need to restrict it to 50% maximum for the startups? As you know, at times the ESOP components are significantly higher.
So there for ESOP, that's what I'm saying. For variable pay, which you cannot identify as a commission, or ESOPs, which we are treating as wages in kind, or like insurance, etc. If we were to keep it, in my understanding, we have to keep it separate because the quantum of the ESOPs could be on a higher side, right? Or whenever those get paid. So as of now, we are looking for clarity on these two specific topics from the facilitator come officer as to how the treatment for ESOPs would be in the eyes of law. So until then, it's still a gray area.
Okay. So there are multiple questions with regard to offer letter and documentation. So offer letter and various other documentation done before this law came in place. A lot of changes happening to existing employee and the offer letters. How one need to factor those at an entity level.
Uh,
This is largely from a documentation perspective.
so we have
Is
to right. So the there are two ways of looking at it. One is for the existing set of employees, the right time to make documentation would be at the time of appraisal, so that we know the employees are ready and willing to take up the revised salary, and that's where we also ensure that we make them sign all the documents to the T. Next thing we need to be also mindful about is onboarding new employees. Whenever we engage new employees, FTEs, consultants, contractors, etc., we have to ensure that the new appointment letters, offer letters that these folks sign are aligned with the labor codes itself. Say let's say for example, if you are paying gratuity on the last drawn salary or on the last drawn wages, at least ensure that the person is not getting paid the variable bonus at the same time. Otherwise your gratuity amount will get blown up a bit. So we have to be mindful that our policies do not reflect that kind of language, to ensure that our liability is also carved out in a specific fashion.
okay. Okay. I think so. That's all. We have some questions which unanswered. You can drop an email to Aditya. You can WhatsApp him. We will respond on all those questions which are unanswered to you through an email so that you get those questions. Uh, and thanks for all the participants who had joined, and hopeful it was as I see, it was an interactive sessions where most of the questions were already answered by three of our panelists.